Warren Buffett, the legendary investor and chairman of Berkshire Hathaway, has long been regarded as one of the most insightful voices in the world of finance. When he speaks, investors and the financial community listen attentively. Recently, Warren Buffett has been sounding the alarm bells about a potential catastrophe looming in the U.S. real estate market. In this video, we will delve into the details of Buffett's warnings and explore the factors contributing to this impending crisis, as well as its potential far-reaching consequences. The $1.4 trillion debt-fueled tsunami. Warren Buffett's concerns stem from a significant debt bubble that has been building up in the U.S. real estate market. Over the last 15 years, the real estate market has been fueled by massive amounts of cheap debt. Low interest rates have encouraged investors and businesses to borrow extensively, driving real estate prices to unprecedented levels. To illustrate this, imagine an office building worth $1 million. A typical buyer might only have $350,000 in cash and would need to secure a $650,000 loan to complete the purchase. The profitability of this investment hinges largely on the interest rate of the loan. At a 5% interest rate, the annual debt payment is $32,500, manageable if the property generates sufficient income. However, when interest rates rise, problems arise. Commercial property loans don't offer fixed rates like residential mortgages. Instead, they reset every few years, which can lead to dramatic increases in debt payments. In Buffett's example, an increase from 5% to 9% could push the annual debt payment from $32,500 to $58,500. If the property's income decreases due to factors like remote work trends, it can quickly become unprofitable. The non-recourse debt dilemma. One crucial aspect of the real estate market that exacerbates the problem is non-recourse debt. Unlike typical home mortgages, commercial real estate loans often come with non-recourse terms. This means that if a property's value falls below the loan amount, the owner can walk away from the property, leaving the lender with the loss. This feature has led to a potentially disastrous situation. Many commercial properties were purchased at peak prices, and as interest rates rise and property values fall, owners may choose to abandon their investments. With approximately $1.4 trillion worth of such loans maturing over the next 2 years, a significant portion of these properties is at risk of foreclosure. The domino effect on small banks and local businesses. While large Wall Street banks dominate many sectors of finance, smaller regional and community banks play a crucial role in commercial real estate lending. These banks are more likely to hold non-recourse loans and, as a result, will be left shouldering the burden of foreclosed properties. This issue extends beyond the financial sector. Smaller banks, the ones most vulnerable to this crisis, are often the primary lenders for small and medium-sized businesses. As these banks face losses from their real estate lending, they may be forced to curtail their overall lending activities. This, in turn, will impact the ability of local businesses to access credit, hindering their growth and potentially leading to economic stagnation. The potential for a long-lasting economic impact. The consequences of a significant real estate crisis extend beyond just the financial sector and local businesses. It can have a far-reaching and long-lasting impact on the overall economy. A cascade of foreclosures and distressed properties can lead to a downward spiral in property values, affecting not only commercial real estate but residential properties as well. Decreased property values can also impact property tax revenues for local governments, potentially leading to budget shortfalls and reduced public services. The resulting economic uncertainty may cause consumers to cut back on spending, which could ripple through various industries, leading to layoffs and reduced economic activity. Moreover, the overall health of the banking sector could be at risk. While the larger Wall Street banks may not be heavily exposed to these non-recourse loans, smaller banks are, and their health is crucial to maintaining a stable financial system. In a worst-case scenario, a wave of bank failures could trigger a broader banking crisis, akin to what happened during the 2008 financial crisis. The future of real estate and the economy. Warren Buffett's warning about a looming real estate crisis serves as a reminder that economic prosperity is not guaranteed. The $1.4 trillion debt bubble in the commercial real estate market, exacerbated by non-recourse loans, poses a significant threat to both the financial sector and the broader economy. While the ultimate outcome of this crisis remains uncertain, it is evident that pain is on the horizon. The key question is who will bear the brunt of it. As investors and citizens, it is essential to heed these warnings, stay informed, and be prepared for the potential consequences that may arise from this real estate storm. In conclusion, the consequences of a real estate crisis can be far-reaching and extend well beyond the property market itself. It is a stark reminder of the interconnectedness of the financial system and the broader economy. As we navigate the uncertain waters ahead, it is crucial for individuals, businesses, and policymakers to remain vigilant and proactive in addressing the challenges posed by this looming crisis. The importance of international coordination. In an interconnected global economy, the repercussions of a significant real estate crisis in one country can spill over into international markets. Therefore, international coordination is crucial to address the potential spillover effects and stabilize the global financial system. Global financial institutions, international financial institutions such as the International Monetary Fund, IMF, and the Bank for International Settlements, BIS, should closely monitor the situation and provide guidance to affected countries. They can offer financial support to countries facing severe economic challenges as a result of the crisis. Collaboration among central banks from different countries should coordinate their monetary policies to manage interest rates and currency exchange rates. A synchronized approach can help prevent excessive volatility in financial markets. Trade and investment flows. Governments should work to maintain stable trade and investment flows in the face of economic uncertainty. Protectionist measures should be avoided, as they can exacerbate the crisis. Data sharing. Promote international data sharing and cooperation in assessing the risks associated with real estate markets. This can help identify emerging trends and potential vulnerabilities in a timely manner. Policy coordination. Encourage policy coordination among countries to address the broader economic consequences of the crisis. Coordinated fiscal and monetary policies can help stimulate economic growth and stability. Financial market surveillance. Strengthen international surveillance of financial markets to detect signs of systemic risks early. This can include sharing information on financial institutions' exposure to non-recourse loans and their interconnectedness with international counterparts. Navigating the real estate storm. The looming real estate crisis, as highlighted by Warren Buffett's warnings, presents a significant challenge for the financial sector, businesses, and governments. While the ultimate outcome remains uncertain, proactive measures can help mitigate the impact and safeguard financial stability and economic growth. Investors and individuals should remain vigilant, diversify their investments, and consider the potential risks associated with real estate holdings, especially those financed with non-recourse loans. Businesses should assess their financial resilience and adapt to changing market conditions. Government and regulatory bodies must play a central role in monitoring, planning, and implementing measures to address the crisis. International coordination is essential to prevent the crisis from spilling over into global financial markets. As we navigate this real estate storm, one thing is clear: the lessons learned from past financial crises underscore the importance of preparedness, transparency, and cooperation among all stakeholders. By working together and taking prudent steps, we can weather the impending crisis and emerge with a more resilient and stable financial system. Thank you for tuning in to this in-depth exploration of the looming real estate crisis and Warren Buffett's warning. If you found this information valuable, please consider subscribing to our channel for more insightful content on finance, investing, and economic trends. Thank you for joining us on this deep dive into Warren Buffett's warning about the impending real estate crisis.